Welcome to the sixth and final episode of Module 3 of our complete English masterclass on capital markets and securities. We close Module 3 by stepping back from the specific instruments and looking at the most fundamental concept in all of finance, the risk-free rate. Every asset price in the modern economy is anchored to the risk-free rate. The valuation of stocks. The pricing of corporate bonds. The cost of mortgages. The cost of car loans. The expected return on a hedge fund. The internal hurdle rate for a corporate project. All of these reference the risk-free rate as their starting point. By the end of this episode you will understand what the risk-free rate actually is, why government bonds provide it, what happens when the risk-free rate moves, and how it propagates through every other asset class. This is the conceptual closing of Module 3 and the bridge to Module 4. Get this right and you understand the foundational mechanism of all of asset pricing. Section 1. What the risk-free rate is supposed to be. The risk-free rate is, in theory, the return you would earn on an investment with absolutely no risk of default or loss. It is the time value of money in its purest form, the compensation for postponing consumption from now until later, without any risk of being repaid less than promised. In a perfectly idealized economy, you could think of the risk-free rate as the rate at which you would lend to yourself across time. There is no credit risk. There is no inflation risk if we are talking about real terms. There is just the price of time. This idealized concept is foundational to economic theory. The capital asset pricing model, the discounted cash flow valuation of stocks, the Black-Scholes option pricing formula, all of these reference the risk-free rate as their primary input. Get the risk-free rate wrong and every downstream valuation is wrong. Section 2. The practical proxy, short-term treasuries. In practice, the risk-free rate is approximated by the yield on short-term government bonds in a stable, developed country currency. The 3-month U.S. Treasury bill is the standard proxy used worldwide for the U.S. dollar risk-free rate. The 3-month German Bund or the 3-month Japanese government bill serve similar roles in euros and yen. These short-term sovereign instruments come closest to the idealized risk-free concept because they have essentially zero default probability and almost no duration risk over their short remaining lives. The yield on these instruments at any moment in time is what every quantitative finance system actually uses. When you read in a research report that the risk-free rate today is 4.1%, that number is almost always coming from the 3-month T-bill auction yield. The theoretical purity of the risk-free rate concept maps onto a specific, observable market price. Section 3. Why government bonds provide the risk-free rate. A natural question is, why government bonds and not, say, the highest quality corporate bonds? The answer has 3 parts. First, default probability. A sovereign government in its own currency has, in principle, infinite ability to print money to repay its debts. Default is possible. Argentina has defaulted multiple times, Greece restructured during the euro crisis, but for major developed country sovereigns it is extraordinarily rare. Second, market depth. Government bond markets are vastly larger and more liquid than even the largest corporate bond markets. The U.S. Treasury market trades hundreds of billions of dollars per day. Apple's bonds, despite being among the most liquid corporate bonds, trade a fraction of that. Third, institutional acceptance. Every financial regulator in the developed world treats sovereign bonds as the safest asset class for capital adequacy purposes. These 3 factors together make government bonds the natural risk-free benchmark. Section 4. How the risk-free rate moves. The risk-free rate is not a constant. It moves daily, with 3 major drivers. First, central bank policy. The Federal Reserve sets the federal funds rate, which directly influences the 3-month T-bill rate. When the Fed hikes, the 3-month bill yield rises. When the Fed cuts, it falls. The transmission is immediate and direct. Second, inflation expectations. Investors require nominal compensation for expected inflation, so when inflation expectations rise, nominal risk-free rates rise. Third, real interest rate dynamics. Independent of inflation and policy, the real risk-free rate moves with productivity expectations and demographic shifts. The combination of these three forces produces the daily movement in the risk-free rate. Over short horizons, central bank policy dominates. Over longer horizons, inflation and productivity matter more. Section 5. Propagation through asset prices. Now we get to the core insight. When the risk-free rate moves, it does not move alone. Every other asset price recalibrates. Consider a stock valued using a discounted cash flow model. The discount rate equals the risk-free rate plus an equity risk premium. If the risk-free rate rises by 1%, the discount rate rises by 1%, and the present value of all future dividends falls. For a growth stock with cash flows mostly in the distant future, the price might fall by 5 or 10% for a 1% risk-free rate increase. For a value stock with cash flows mostly in the near future, the price might fall by only 2 or 3%. The same logic applies to bonds. When the risk-free rate rises, all bond prices fall. The same logic applies to real estate, to art, to private equity. Everything that can be valued through discounted cash flows responds to changes in the risk-free rate. Section 6. The risk-free curve, not just one number. There is one technical subtlety we should make explicit. The risk-free rate is not really one number. There is a risk-free rate for every maturity. The 3-month risk-free rate. The 2-year risk-free rate. The 10-year risk-free rate. The 30-year risk-free rate. Each of these is different, and the differences are captured by the yield curve we discussed in the previous episode. For pricing a 1-year cash flow, you use the 1-year risk-free rate. For pricing a 10-year cash flow, you use the 10-year risk-free rate. For pricing an entire stream of cash flows spread over time, you use the full risk-free yield curve and discount each cash flow at the appropriate rate. The single risk-free rate number you hear quoted in the media is typically the 3-month or the 10-year, and which one matters depends on context. A serious valuation uses the entire curve. Section 7. The risk-free rate when nothing is risk-free. In the depths of the 2008 financial crisis, even short-term U.S. Treasury bills traded at slightly negative yields for brief periods. The market was so desperate for safe assets that investors were willing to pay the Treasury to hold their money. This was not because Treasuries had become risk-free. It was because all the alternatives had become so risky that even paying for safety was preferable. Similar episodes have occurred during the European debt crisis, the COVID panic, and other moments of acute stress. In these moments, the very concept of risk-free starts to bend. What is the risk-free rate when government default suddenly becomes a market concern? In the Eurozone crisis, German bonds remained safe while Greek and Italian bonds did not. The risk-free benchmark for Eurozone investors became bond, not the broader European yield curve. Risk-free is relative, not absolute, and it depends on the country, the currency, and the moment. Section 8. Why the risk-free rate matters to you. Let us close with the practical implication. The risk-free rate matters to you, the investor, in 4 direct ways. First, it determines what you earn on cash and money market funds. When the risk-free rate is at 4%, your cash position earns about 4%. When it is at 0, cash earns nothing. Second, it sets the hurdle for any risky investment. If you cannot earn at least the risk-free rate, you should hold Treasury bills. Third, it affects valuations across your entire portfolio. When the risk-free rate moves, your stocks and bonds move. Fourth, it signals the central bank's stance and the economic environment. A rising risk-free rate signals a tightening cycle. A falling rate signals easing. Every personal finance decision and every investment decision happens against the backdrop of the prevailing risk-free rate. Understanding it is fundamental to financial literacy. Conclusion. The risk-free rate is the foundation of every asset price in modern finance. In theory, it is the pure time value of money with no risk. In practice, it is approximated by short-term sovereign yields. Government bonds provide it because of low default risk, deep markets, and regulatory acceptance. The rate moves with central bank policy, inflation expectations, and real interest rate dynamics. When the risk-free rate moves, every other asset price recalibrates. The risk-free rate is not one number but a curve across maturities. During crisis episodes, the concept itself becomes strained. And it matters to every investor because it determines cash yields, hurdle rates, valuations, and signals about the economic environment. Module 3 is now complete. We have covered why sovereigns issue, the maturity spectrum, fixed coupon mechanics, variable rate notes, the yield curve, and the risk-free rate. In Module 4 we move from sovereign and corporate bonds to inflation-linked bonds, bonds whose principal and coupon adjust to a published inflation index. If you found this episode useful, please share it and subscribe to Capital Markets and Securities with Michael for the full 48-episode course.